I lost half my portfolio trying to catch falling knives in the 2022 bear market. That was John, one of my subscribers who kept buying stocks as they dropped, hoping to find the bottom. By switching to the momentum approach I'm about to show you, he's not only recovered his losses, but is now up 35% since implementing this strategy. Today I'm breaking down the exact momentum framework that's been used by top hedge funds for decades, but rarely explained to everyday investors. You'll learn how to spot market trends early, ride them higher, and, most importantly, know exactly when to get out before the trend reverses. The retail investor's dilemma: why you're probably underperforming the market. Is your investment portfolio a constant source of frustration? You've done your homework, researched companies for hours, carefully picked stocks you believed in, and yet somehow, your returns still lag behind the market. Don't worry, you're not alone in this struggle. Let's face it, most retail investors are facing an uphill battle. Despite all the time and effort you pour into your investment decisions, the numbers tell a brutal story. According to Dalbar's annual quantitative analysis of investor behavior, the average equity fund investor has underperformed the S&P 500 by a staggering 4.5% annually over the past 30 years. Think about that. If the market returned 10% on average, retail investors only captured about 5.5%. That's leaving almost half of your potential returns on the table. Even more shocking, over a 20-year period ending in 2020, while the S&P 500 averaged around 7.5% annual returns, the average retail investor barely managed 2.9%. That's not just underperformance, it's a financial disaster in slow motion. All that time spent reading financial news, watching CNBC, and analyzing company reports, and you might have been better off closing your eyes and buying a simple index fund. But why does this happen? It's not because retail investors aren't smart enough. The problem lies in our psychology, the emotional traps that catch even the most well-intentioned investors. FOMO, fear of missing out, drives us to buy high when everyone's celebrating a stock's success. That crypto that just jumped 300%. That tech stock hitting all-time highs? Our brains are wired to want in on the action, precisely when we should be most cautious. Then there's panic selling, the overwhelming urge to cut losses when markets plummet. Remember March 2020? As the pandemic sent markets crashing, retail investors pulled a record $326 billion from mutual funds and ETFs in that single month. Many sold at the absolute bottom, locking in their losses, and then missed the historic rally that followed. Those who sold in panic missed out on one of the fastest recoveries in market history, with the S&P 500 reaching new highs just months later. I've seen these mistakes repeatedly among friends and viewers. Take Mark, who went all in on tech stocks in late 2021 because everyone was making a killing, only to watch his portfolio drop 40% in 2022. Or Jessica, who spent months trying to time the perfect entry point for her investments, keeping her money in cash through one of the strongest bull markets in history because she was waiting for a correction that came much later, and at much higher levels than where she could have entered. These aren't isolated incidents. Research from Vanguard shows that investors who try to time the market underperform those who stick to a consistent plan by nearly 1.5% annually. That might not sound like much, but compounded over decades, it's the difference between a comfortable retirement and working well into your 70s. The opportunity costs of these mistakes are massive. If you had invested $10,000 in the S&P 500 in 2000 and just left it alone for 20 years, you'd have about $32,000. But the average retail investor's returns would turn that same $10,000 into only about $17,600. That's over $14,000 in missed gains, enough to buy a car or make a significant dent in college tuition. What's particularly frustrating is how we tend to blame everything except our approach. It's the Fed's fault. It's market manipulation. It's hedge funds or high-frequency traders working against us. While external factors certainly play a role, the hard truth is that our own behavior is usually the biggest culprit. Meanwhile, professional investors have been quietly using systematic approaches that remove emotion from the equation. They don't try to predict market bottoms or tops. They don't chase hot tips from Reddit or Twitter. Instead, they follow disciplined systems that recognize and capitalize on existing market trends. One of the most powerful of these systems? Momentum investing. While retail investors are busy trying to be Warren Buffett, finding undervalued companies, or Cathy Wood, spotting the next disruptive innovation. Professional traders are simply identifying what's already working in the market and riding those trends for substantial profits. The problem isn't your intelligence or how much research you do. It's not even about finding better stock picks. The real issue is your strategy. Specifically, the lack of a systematic approach that protects you from your own worst instincts. Momentum investing offers exactly that, a framework that turns the psychological factors that typically work against retail investors into advantages. Think about it. Instead of fighting against FOMO by trying to resist exciting stocks and then giving in anyway, momentum investing channels that energy into a disciplined system. Rather than pretending you won't panic sell during downturns, we all think we won't until we do. Momentum strategies build in exit rules that protect your capital before panic sets in. Wall Street's secret weapon, what momentum investing actually is. Channeling FOMO into a structured approach is exactly why momentum investing has remained Wall Street's favorite secret weapon for decades. When academic researchers finally put this strategy under the microscope, they discovered something shocking. The buy high, sell higher approach has consistently beaten the market for over 200 years, through wars, depressions, and every market condition imaginable. This isn't just some flash-in-the-pan investment fad. It's a time-tested approach that the financial elite have been using while telling the rest of us to be patient and think long-term. So what exactly is momentum investing? At its core, it's beautifully simple. You buy securities that are already rising in price and sell those that are falling. That's it. No complex valuation models, no poring over balance sheets until your eyes bleed, no trying to outsmart Wall Street analysts who do this 80 hours a week. You're simply identifying and riding trends that are already in motion. I know what you're thinking. But wait, isn't that the opposite of buy low, sell high? Absolutely. And that's precisely why it works. The conventional wisdom of buying low and selling high sounds great in theory, but in practice, it means fighting against market psychology. It requires you to be contrarian at exactly the moments when your emotions are screaming at you to follow the crowd. Let's talk evidence. In 1993, Professors Narasimhan Jagadish and Sheridan Titman published what would become a landmark study showing that stocks which performed well over the past 3 to 12 months continued to outperform in the following months. This wasn't just a small edge. These strategies generated significant positive returns that outpaced basic buy-and-hold approaches even after accounting for costs. But the research didn't stop there. According to Cliff Asness, a heavyweight in quantitative investing, the existence of momentum is a well-established empirical fact. The return premium is evident in 212 years of U.S. equity data, in more than 20 years of out-of-sample evidence from its original discovery, in 40 other countries, and in more than a dozen other asset classes. That's not my opinion. That's one of the most respected financial minds in the world looking at centuries of data. Why does momentum work so consistently? It taps into fundamental aspects of human psychology. When news hits the market, investors typically underreact initially, then gradually adjust their positions as information spreads. This creates trends that persist longer than efficient market theory would predict. Essentially, momentum investing capitalizes on the fact that markets don't instantly price in all information. They react and adjust over time. Now, let's compare momentum to other investing strategies you might be familiar with. Value investing looks for bargains, stocks trading below their intrinsic value. Growth investing seeks companies with above-average growth potential. Passive indexing simply buys the entire market. All valid approaches, but momentum has a distinct advantage. It doesn't require you to predict the future or outsmart other investors. You're simply identifying what's already working and riding that wave until it stops. What's particularly interesting is how momentum performs during different market conditions. During inflationary periods, momentum stocks have historically delivered higher returns than value stocks. This makes sense when you think about it. Companies that can raise prices successfully during inflation are demonstrating strength that tends to persist. But momentum isn't just a one-trick pony. It's shown outperformance across a variety of economic conditions. So if momentum is so effective, why isn't your financial advisor recommending it? Why aren't there momentum investing commercials sandwiched between every football game? The answer reveals a lot about how Wall Street actually operates. The truth is, hedge funds and institutional investors have been quietly using momentum strategies for decades. They employ sophisticated quantitative methods to identify and capitalize on price trends, generating billions in profits along the way. But these strategies are rarely promoted to retail clients like you and me. They're considered too complex, too risky, or too active for the average investor. There's also a more cynical explanation. Wall Street makes more money when you stay in your lane. Recommending a passive index fund or a traditional 60-40 portfolio requires minimal effort and keeps you dependent on their expertise. Teaching you to identify and ride momentum would empower you to make your own decisions and potentially outperform many professional managers. The irony is that momentum investing isn't some complex strategy reserved for math geniuses with supercomputers. At its heart, it's a systematic approach that anyone can implement with the right framework. It's not gambling or day trading. Those involve making unpredictable bets on short-term price movements. Momentum investing is about identifying established trends and having clear rules for entry and exit. Think of it this way. Value investors are like people searching for diamonds in the rough. Momentum investors are like surfers watching the ocean, waiting for the right wave to form, then riding it as long as possible. Both can be successful approaches, but surfing requires less prediction and more observation. The beauty of momentum investing is that it works with market psychology rather than against it. Instead of fighting the tide of investor sentiment, you're channeling it into a disciplined framework. You're not trying to predict where the market will go next. You're simply recognizing where it's already going and joining that movement until the evidence shows its changing direction. Spotting real momentum. How to identify trends worth following. Now here's a question that separates the pros from the amateurs. Ever bought a stock that seemed to be skyrocketing, only to watch it crash the very next week? Recognizing actual momentum versus temporary price spikes isn't just helpful. It's absolutely essential if you want to avoid becoming another statistic in the momentum investing casualty list. Did you know that nearly 40% of apparent breakouts fail within the first 2 weeks? That's right. What looks like a rocket ship ready for takeoff often turns out to be a quick elevator ride back to the ground floor. The problem isn't momentum investing itself. It's that most investors can't tell the difference between genuine momentum and market noise. Let's be honest about why this happens. When we see a stock climbing rapidly, our brains flood with dopamine and FOMO takes the wheel. We jump in without asking critical questions. Is this rise supported by real buying pressure? Is it outperforming both its sector and the broader market? Or is it just experiencing a temporary sugar rush? The good news is that separating true momentum from fool's gold isn't guesswork, it's science. And it starts with understanding 3 essential indicators that professional investors never ignore. First up, technical indicators that quantify momentum. The Relative Strength Index, RSI, functions like a speedometer for stock movements, ranging from 0 to 100. When a stock's RSI climbs above 70, conventional wisdom says it's overbought and due for a pullback. But here's what the average investor misses. Strong momentum stocks can maintain overbought conditions for extended periods during powerful trends. Another key technical tool is the Moving Average Convergence Divergence, MACD, which compares the relationship between 2 moving averages, typically the 12-day and 26-day exponential moving averages. When the shorter-term average crosses above the longer-term average, it signals strengthening momentum. This isn't just about direction, it's about acceleration. The rate of change, ROC, indicator gives you yet another perspective by calculating the percentage difference between a stock's current price and its price from a specified period ago. This helps you determine not just if a stock is moving, but how fast it's moving compared to its recent history. But here's where most momentum investors mess up. They look at these indicators in isolation without considering volume patterns. Volume is the heartbeat of momentum. Think of it as the difference between a car moving downhill because someone's pushing it versus because the engine is running. One isn't sustainable, the other is. When a stock rises on increasing volume, it signals genuine investor conviction and often indicates institutional money flowing in. These are the big players, hedge funds, pension funds, and investment banks, whose participation can sustain momentum for weeks or months. Conversely, price jumps on declining volume are like warning flares, signaling potential reversals. They're the market equivalent of a sugar rush. exciting in the moment, but ultimately unsustainable. The third critical component is relative strength compared to both sector peers and the broader market. This is where you separate true momentum from stocks that are simply rising because everything else is. A stock with genuine momentum doesn't just move up, it outperforms its sector and the overall market. You can measure this using ratio charts that compare a stock's performance against a benchmark like the S&P 500 or its sector ETF. When the ratio line is climbing, the stock is outperforming the comparison index. This relative strength often precedes continued outperformance, a signal that smart money is concentrating in specific opportunities rather than just riding a rising tide. Time frame analysis adds another crucial dimension. Different time frames can tell completely different stories about momentum. A stock might show strong upward momentum on a daily chart, but look considerably weaker on a weekly or monthly basis. This multi-time frame approach helps distinguish between short-lived bounces and substantial trends worth following. Consider the real-world example of NVIDIA, which delivered a staggering 168% gain for investors over the past year. This wasn't just a random price spike. It was textbook momentum supported by increasing volume, strong relative performance against both the tech sector and the broader market, and powerful trends across multiple time frames. The momentum was driven by fundamental catalysts too, specifically surging demand for NVIDIA's GPUs in AI applications. Contrast that with stocks experiencing false breakouts, which typically show temporary price jumps driven by speculation or market noise rather than sustainable buying pressure. These pretenders initially look exciting but quickly fade when the volume and relative strength aren't there to support continued movement. What makes false breakouts so dangerous is that they often look identical to genuine breakouts in their early stages. The price action can appear compelling, sometimes even explosive. But without the confirmation of increasing volume and sector outperformance, these promising moves frequently reverse, trapping unwary investors. This is precisely why a systematic approach to identifying momentum is so important. By combining technical indicators with volume analysis and relative strength measurements, you create a filtering system that weeds out the imposters and highlights stocks with genuine momentum potential. Remember that momentum isn't simply about a stock going up. It's about a stock going up for reasons that suggest it will continue going up. True momentum has staying power because it's supported by a combination of technical strength, institutional buying, and relative outperformance across different time frames. The 5-step momentum system anyone can implement. Understanding momentum is one thing, but implementing it consistently is where 87% of investors fail. The difference between knowledge and execution isn't about having more information. It's about having a systematic approach that removes emotion and forces you to stick with what works, even when your instincts are screaming at you to do otherwise. Look, we all know that most investing approaches feel like you need a PhD to implement them properly. You've got value investors poring over financial statements for days, growth investors trying to predict the next decade of innovation, and technical traders with screens that look like they belong in NASA's control room. But what if I told you that momentum investing can be distilled into just 5 straightforward steps that anyone can implement in about 30 minutes per week? Let me walk you through the 5-step momentum system that can transform how you approach the market. Step 1. Screen for stocks showing strong relative strength. This is where everything begins. Remember how we talked about identifying stocks that are outperforming? Here's how you actually find them. Use a basic stock screener. Most brokerages offer them for free, and filter for stocks that are outperforming both their sector and the broader market over the past 3, 6, and 12 months. You're looking for consistent outperformance across multiple time frames, not just a one-week wonder. This narrows down the entire stock universe to maybe 50 to 100 candidates that are actually showing meaningful momentum. Step 2. Create a simple momentum scoring system. This is where most people overcomplicate things, but it can be surprisingly straightforward. You can build a basic system using just 3 technical indicators: moving averages, like the 50-day and 200-day, the Relative Strength Index, RSI, and the Moving Average Convergence Divergence, MACD. Each stock gets points based on these indicators. For example, 2 points if the 50-day moving average is above the 200-day, 1 point if RSI shows strong but not overbought momentum, and so on. The beauty of this approach is that it quantifies momentum instead of relying on gut feelings or subjective assessments. Step 3. Rank your opportunities based on momentum scores. Once you've assigned scores to your candidates, simply rank them from highest to lowest. This creates a clear priority list that tells you exactly which stocks deserve your attention and which ones you can ignore. The top 10 to 15 stocks on this list become your primary watch list. What's powerful about this step is that it forces you to focus on the stocks with the strongest momentum signals rather than getting distracted by companies you find personally interesting or exciting. Step 4. Implement proper position sizing based on momentum strength. This is the step that saves your portfolio when things go wrong. A fundamental rule in momentum investing is to never risk more than 1 to 2% of your total portfolio on a single trade. But here's the advanced approach. Adjust your position sizes based on the momentum score. A stock with an exceptionally high momentum score might warrant a full 2% allocation, while a stock with just decent momentum might only get 0.5 to 1%. This creates natural diversification while allocating more capital to your strongest opportunities. Let me give you a quick example. If you have a $50,000 portfolio, your maximum position size would be $1,000, 2%. For a stock with the highest momentum score, you might invest the full $1,000. For a stock with a moderate score, you might only invest $500. This systematic approach ensures you're not overexposed to any single position while still capitalizing on the strongest trends. Step 5. Set up a systematic review process with clear buy-sell rules. The final step is creating a schedule for reviewing your momentum portfolio. For most retail investors, a quarterly review hits the sweet spot, frequent enough to catch meaningful changes, but not so frequent that you're constantly tinkering. At each review, run your stocks through your scoring system again and make adjustments based on changing momentum. What's fascinating is that research shows different optimal trading frequencies based on your portfolio size. If you're working with a smaller portfolio, under $10,000, more frequent monthly rebalancing might enhance your returns. For larger portfolios, quarterly rebalancing often performs better by minimizing transaction costs while still capturing major trends. Your review should follow a checklist. Which positions still show strong momentum? Which have weakened? What new candidates have appeared in your screening? Having predetermined buy and sell rules removes the emotion from these decisions. For example, sell any position whose momentum score drops below 3, or add to positions whose scores increase by 2 or more points. The real magic of this 5-step system isn't in any individual component. It's in the consistency and discipline it creates. By following the same process week after week, month after month, you're essentially putting your investing on autopilot. You no longer have to agonize over every decision or second-guess yourself after making a trade. Think about what this means practically. Instead of spending hours reading conflicting analyst reports, debating with yourself about economic forecasts, or getting swayed by CNBC's panic or euphoria, you simply follow your system. Screen, score, rank, size, and review. That's it. What's even more powerful is that this approach works across different market environments. In bull markets, it keeps you invested in the strongest trends. In bear markets, your regular reviews will naturally move you toward defensive positions or cash as momentum fades. The system adapts without you having to predict where the market is heading. By implementing this 5-step momentum system, you're not just investing differently, you're investing smarter. You're making decisions based on quantifiable metrics rather than hunches or headlines. You're removing the emotional roller coaster that destroys so many portfolios. And most importantly, you're giving yourself a fighting sector rotation, catching the next big wave before it crests. Did you know that over 50% of a stock's movement is influenced by its sector, not company-specific factors? That's right, you could pick the perfect stock, but still lose money if you're fishing in the wrong pond. Now that you've got your momentum system for individual stocks, let's zoom out to the bigger picture that can make or break your returns. Professional investors have a secret weapon that most retail traders completely miss: sector rotation. While you're busy analyzing quarterly earnings reports and management teams, the smart money is quietly positioning themselves in entire market sectors before they explode with momentum. Think about it. How often have you picked what seemed like a solid company, only to watch it struggle because its entire industry was facing headwinds. Most retail investors make this critical mistake. They fall in love with individual stocks without considering whether that company's sector is gaining or losing momentum in the current economic environment. What makes sector rotation such a powerful strategy is how it aligns with the natural rhythm of the economy. The market doesn't move as one unified entity. It ebbs and flows in predictable patterns. Different sectors take turns leading the market based on where we are in the economic cycle. During economic expansion phases, growth-oriented sectors like technology, consumer discretionary, and industrials typically outperform. These companies benefit directly from increased consumer spending and business investment. When you see these sectors gaining strength, it's often a signal that the economy is heating up. Conversely, when the economy starts contracting, defensive sectors like utilities, healthcare, and consumer staples tend to shine. These are the businesses selling products and services people need regardless of economic conditions. When these defensive sectors start outperforming, it could indicate economic storm clouds on the horizon. The beauty of sector rotation is that you don't need to predict these shifts. You just need to identify them as they're happening. This is where ratio charts become invaluable tools in your momentum arsenal. By comparing the performance of sector ETFs against a benchmark like the S&P 500, you can visually see which sectors are gaining strength and which are fading. For example, if you plot the consumer discretionary ETF divided by the S&P 500 on a chart, an upward-sloping line shows the sector is outperforming the broader market, a classic sign of building momentum. When the line turns downward, it suggests the sector's relative strength is weakening. The sweet spot for sector momentum investing is identifying sectors transitioning from laggards to leaders. When a ratio chart shows a sector has been underperforming for months, but suddenly crosses above its moving average, that's often the beginning of a major trend change and a potential opportunity to position yourself ahead of the crowd. Right now, current market data points to a fascinating shift underway. We're seeing notable strength in sectors like consumer discretionary, communication services, financials, and energy. This rotation toward more offensive investments suggests improving market conditions that many individual investors haven't yet recognized. By positioning yourself in these sectors now, you could potentially capture significant momentum before the average investor even notices the trend. Here's how you can capitalize on sector momentum using ETFs. Instead of trying to pick individual winners within a hot sector, you can simply buy an ETF that gives you exposure to the entire sector. This approach has two major advantages: diversification within the sector and simplicity. You don't need to become an expert on dozens of companies. You just need to identify which sectors are gaining momentum. For example, rather than trying to decide whether Exxon, Chevron, or Shell is the best energy play, you could simply buy an Energy Select Sector SPDR ETF, XLE, when the energy sector starts showing relative strength. This gives you exposure to the entire sector's momentum without company-specific risk. But timing is everything with sector rotation. The Trend Strength Indicator, TSI, helps you identify precisely when a sector is gaining momentum and the optimal time to rotate your investments. This indicator measures both the direction and strength of a trend, helping you distinguish between temporary bounces and significant momentum shifts. Let's walk through a quick example of how this might work in practice. Imagine the economy is transitioning from early recovery to full expansion. Your ratio charts show the financial sector starting to outperform after months of lagging. The TSI confirms this isn't just a temporary bounce, but the beginning of a significant trend. This would be your signal to rotate some of your portfolio into financial sector ETFs or selected financial stocks showing the strongest momentum. Some of the most successful sector rotation trades in history have come from these economic transition phases. Investors who recognize the shift toward technology and consumer discretionary stocks early in recovery phases have captured remarkable returns as these sectors benefited from increased consumer spending and investment. During inflationary periods like we've experienced recently, energy and materials sectors often lead the market. Their ability to pass higher costs to consumers makes them natural hedges against inflation. Meanwhile, sectors like consumer staples and utilities might struggle due to rising input costs they can't fully pass along. Building your momentum scoring system, removing emotion from investing. While sector selection can shield your investments during inflation, there's an even bigger enemy lurking in your portfolio, and it's looking right back at you in the mirror. Our emotions can sabotage even the best investment strategies, creating a gap between what we know we should do and what we actually do when markets get volatile. That's why today, we're building a momentum scoring system that puts math in charge of your money, not your feelings. Have you ever held onto a losing stock way too long, hoping it would bounce back? Or maybe you've panic sold during a market dip, only to watch those same stocks recover a week later? You're not alone. Even seasoned investors fall victim to these psychological traps when they rely on gut feelings instead of data. The problem isn't your intelligence, it's human psychology. Our brains are wired with cognitive biases that made perfect sense for survival thousands of years ago, but wreak havoc on our investment decisions today. Loss aversion makes us hold losers too long. Confirmation bias has us ignoring warning signs in stocks we love. And recency bias tricks us into chasing yesterday's winners after they've already peaked. So how do we overcome these hardwired tendencies? By creating a quantitative momentum scoring system that makes decisions clear and emotion-free. Let's break down the key components of an effective momentum scoring system. Rather than making subjective judgments, we'll assign specific numerical values to measurable factors. This transforms vague feelings like "this stock seems strong" into precise scores that trigger clear actions. The foundation of your scoring system should include price action, relative strength, and volume trends. These factors have proven reliable in identifying stocks with genuine momentum that's likely to continue. Research shows that stocks with strong relative performance over the past 3 to 12 months tend to maintain that outperformance in the future. For price action, you'll want to track how consistently a stock is making higher highs and higher lows, the hallmark of an uptrend. Is the stock trading above its major moving averages? Is it making new 52-week highs? These factors deserve significant weight in your scoring system. Relative strength compares a stock's performance against competitors and the broader market. A stock gaining 10% might seem impressive until you realize its sector gained 15% during the same period. True momentum leaders outperform their peers, not just rise with the tide. Volume provides crucial confirmation of price movements. When a stock rises on increasing volume, it suggests real institutional money is flowing in, not just short-term traders. This volume confirmation deserves significant weight in your scoring system as it helps distinguish between sustainable momentum and temporary price spikes. Now, not all factors should carry equal weight in your system. The beauty of building your own momentum scoring framework is customizing it to your investment style and time horizon. If you're a swing trader focusing on weeks rather than months, recent price action might deserve a 50% weighting in your system, while longer-term relative strength might only get 25%. Let me show you how this might work in practice. You could assign 0 to 3 points for each factor, creating a simple 10-point scoring system. For price action, award 3 points if the stock is above all major moving averages and making new highs, 2 points if it's above most moving averages, 1 point if it's showing mixed signals, and 0 if it's clearly in a downtrend. For relative strength, give 3 points if the stock is outperforming both its sector and the market over multiple time frames, 2 points if it's outperforming in most comparisons, and so on. For volume trends, award 3 points for consistently increasing volume on up days and decreasing volume on down days, which indicates healthy accumulation. Finally, add 1 point for smoothness. Stocks with steady upward progress rather than erratic moves tend to be more reliable momentum plays. Once you've calculated these scores, you need clear thresholds for decision-making. This is where many investors falter. They calculate scores, but still make emotional decisions about what to do with them. Instead, establish specific buying and selling rules. Scores of 8 to 10, strong by candidates that deserve full position sizing. Scores of 6 to 7, moderate by candidates with smaller position sizes. Scores of 4 to 5, hold existing positions but don't add more. Scores of 0 to 3, sell candidates that should be exited. These predefined thresholds remove the agony of decision-making during market volatility. When emotions are running high and everyone's panicking, you simply check your scores and follow your rules. The best part, you can track all this in a simple spreadsheet. Create columns for each component of your scoring system, then use basic formulas to calculate the final scores automatically. I recommend tracking scores weekly for most investors, frequent enough to catch important changes, but not so often that you're tempted to overtrade. What makes this approach particularly powerful is how it acts as an early warning system for trend reversals. Often, momentum doesn't die overnight. It deteriorates gradually. Your scoring system will catch these subtle shifts before the stock price collapses, allowing you to exit positions while they're still profitable. For example, you might notice a previously strong stock's volume pattern changing, with selling pressure increasing on down days. This could drop its score from 8 to 6, not triggering an immediate sell, but putting you on alert. If the following week shows deterioration in relative strength, dropping the score to 4, you have a clear sell signal, all before a major price breakdown occurs. This systematic approach transforms how you handle market volatility. When others are frozen with indecision during corrections or bubbling with FOMO during rallies, you simply consult your scoring system and take the appropriate action. The market's emotions no longer dictate your decisions, your system does. Think about how liberating that would feel. No more lying awake at night agonizing over whether to sell a struggling position. No more second-guessing yourself after making a trade. The scoring system becomes your emotional circuit breaker, protecting you from your worst investing impulses. The performance edge, momentum versus buy and hold in different markets. Now that you've armed yourself with an emotional circuit breaker, you're probably wondering if all this effort is actually worth it. With your scoring system in place, you're free from emotional decision-making. But the million-dollar question remains. Does momentum investing really outperform the tried-and-true buy-and-hold approach that most financial advisors recommend? Let me hit you with something that might shock you. Momentum strategies have actually outperformed traditional buy-and-hold approaches in 7 out of the last 10 market corrections. That's not just a slight edge, it's a pattern that deserves your attention. Many investors remain deeply skeptical about momentum investing. I get it. We've all been told that you can't beat the market consistently, that index funds are the only sensible choice, and that trying to outperform is a fool's errand. But what if that conventional wisdom isn't the whole story? The historical data tells a different tale. When we look at comprehensive analyses across different market environments, momentum strategies have consistently delivered impressive results. During bull markets, both approaches tend to perform well, but momentum often edges out buy and hold by capitalizing on the strongest performers within the broader uptrend. But here's where it gets really interesting. During bear markets and sideways markets, the difference becomes much more dramatic. While buy and hold investors were watching their portfolios sink during market corrections, momentum strategies were often able to pivot quickly, moving capital away from declining sectors and into areas of relative strength. Take the 2008 financial crisis, for example. As markets plummeted, momentum indicators began flashing warning signs weeks before the worst of the crash. Investors following momentum signals had the opportunity to reduce exposure to financial stocks and increase positions in more defensive sectors. The result? Significantly smaller drawdowns compared to those who simply held through the carnage. The 2020 pandemic crash tells a similar story. When COVID-19 sent markets into a tailspin, momentum strategies quickly identified the shift and pointed toward beneficiaries of the new environment. Technology companies enabling remote work, healthcare innovations, and digital entertainment. While buy-and-hold investors eventually recovered, momentum investors were able to capture the upside in these sectors much earlier in the recovery. Even the 2022 correction, triggered by inflation concerns and rising interest rates, showed momentum's adaptability. As growth stocks faltered, momentum signals highlighted strength in energy, commodities, and value-oriented sectors, precisely the areas that held up best during this challenging period. But raw returns only tell part of the story. When we look at risk-adjusted performance using metrics like the Sharpe ratio, which measures returns relative to volatility, momentum strategies really shine. Across multiple studies, momentum approaches have demonstrated consistently higher Sharpe ratios compared to buy-and-hold strategies. This means you're not just potentially earning better returns, you're doing it with better risk management. What's particularly remarkable is that these patterns aren't just a recent phenomenon. Academic research has documented momentum's effectiveness across more than 2 centuries of market data. One comprehensive study published in the Journal of Portfolio Management found persistent momentum outperformance across multiple asset classes and countries over 212 years of data. That's not a fluke. It's a fundamental market behavior that savvy investors can harness. Momentum investing has proven especially powerful during periods of high inflation, like the one we're currently experiencing. Studies show that momentum stocks outperformed the broader market in 6 out of 8 high inflation periods analyzed. This makes intuitive sense when you think about it. During inflationary times, companies with pricing power and strong market positions tend to maintain their upward trajectory, while weaker companies struggle to adapt. Of course, momentum investing isn't without its critics. Some argue that it can lead to significant losses if you don't adapt to changing market conditions. This is a fair point. Momentum isn't a set-it-and-forget-it approach. It requires vigilance and disciplined implementation of your rules. But that's precisely why we've built a scoring system, to remove emotion from the equation and make consistent decisions. Others point out that momentum strategies can generate higher transaction costs due to more frequent trading. This is true, but with today's commission-free trading platforms and the rise of low-cost ETFs, this disadvantage has been dramatically reduced for retail investors. The most compelling aspect of momentum investing might be its ability to reduce drawdowns during market corrections. While a buy-and-hold investor might experience a 30 to 40% drop during a bear market, well-executed momentum strategies have historically limited these drawdowns to much smaller percentages. This matters immensely for long-term wealth building because the math of recovery is brutal. A 50% loss requires a 100% gain just to break even. What's particularly powerful is that momentum works across various market conditions: bull markets, bear markets, and even sideways markets. This versatility makes it an incredibly useful tool in your investing toolkit, regardless of what the broader economic environment might be. The academic consensus is clear. Momentum strategies can yield significant returns when properly implemented. The key phrase here is properly implemented. This isn't about day trading or making impulsive decisions. It's about systematically identifying trends and riding them until they show clear signs of reversal. What makes momentum particularly effective is that it works with market psychology rather than against it. Markets don't move in straight lines because human emotions drive overshooting in both directions. Momentum strategies capitalize on this by following position sizing and risk management, the rules that save your portfolio. Following market trends is only half the battle in momentum investing. Did you know that a single position sizing mistake could wipe out 6 months of careful momentum gains in just one bad trade? Even the most promising momentum strategy will fail if you neglect the invisible guardrails that keep your portfolio safe. While we've covered how to identify trending stocks and create a momentum scoring system, all that work becomes meaningless without proper risk management. It's like building a Ferrari engine but forgetting to install brakes. You might go fast for a while, but the ending won't be pretty. The most dangerous mistake momentum investors make isn't picking the wrong stocks. It's putting too much money into a single position. Think about it. You could be right on 8 out of 10 trades, but if those 2 losers drain 30% of your portfolio, you're still in the red. This is why professional momentum investors obsess over position sizing more than stock selection. The golden rule that separates successful momentum investors from the unsuccessful is surprisingly simple. Never risk more than 1 to 2% of your total portfolio on any single position. This might sound overly cautious, but it's actually the secret weapon that allows you to stay aggressive with your stock picks while keeping your overall risk in check. Let me show you how this works in practice. If you have a $50,000 portfolio and follow the 1% rule, you'd limit your potential loss on any single stock to $500. This doesn't mean you only invest $500. It means you size your position and place your stop loss so that if the trade goes against you, you lose no more than $500 before exiting. For example, if you're buying a stock at $100 and setting a 10% stop loss at $90, you could purchase 50 shares, $5,000 position, because your maximum loss would be limited to $500. But what if the stock is more volatile and needs a 20% stop loss? Then you'd only buy 25 shares, $2,500 position, to maintain the same $500 maximum loss. This approach means your position sizes aren't arbitrary. They're precisely calculated based on your portfolio size and the specific risk of each trade. Stocks with higher volatility get smaller positions, while more stable momentum plays can receive larger allocations. Stop-loss strategies are particularly crucial for momentum investing because trends can reverse quickly. The standard approach is setting your stop-loss order about 10% below your purchase price. This gives the stock enough wiggle room for normal volatility while protecting you from significant losses if the momentum truly breaks down. But here's where many investors go wrong. They set a stop-loss but then convince themselves to ignore it when the stock hits that price. It's just temporary, they tell themselves. It'll bounce back. Next thing they know, that 10% loss becomes 20%, then 30%, and suddenly they're hoping just to break even. To avoid this trap, consider using actual stop-loss orders that automatically trigger when prices hit your predetermined exit point. Once a momentum stock starts moving in your favor, trailing stops become your best friend. Unlike regular stop-losses that remain fixed, trailing stops move up with the stock price. If a stock you bought at $100 rises to $150, you might set a trailing stop 10% below the current price at $135. This locks in most of your gains while still giving the stock room to fluctuate. If the price continues climbing to $200, your trailing stop would move up to $180, continuing to protect your growing profits. Trailing stops are perfect for momentum investing because they solve the age-old question of, when do I sell? Instead of trying to pick the exact top, which is impossible, you simply let the market tell you when the uptrend is breaking down. Beyond individual position sizing, you need to manage what professionals call portfolio heat, the total risk exposure across all your momentum positions. Even if each individual position is sized correctly, having too many correlated positions can create dangerous concentration risk. For example, if you have 5 tech stocks each sized at 2% risk, and the tech sector suddenly drops 15%, you could find yourself facing a much larger portfolio loss than anticipated. This is why you need to limit exposure to any single sector and consider correlations between your positions. A practical approach is to limit your total risk in any single sector to no more than 5 to 8% of your portfolio. This means if you're already at your tech sector limit, you'd either need to reduce existing positions before adding a new tech stock or simply wait for better opportunities in other sectors. During periods of high market volatility, consider reducing your position sizes across the board. Instead of risking 1% per position, you might temporarily drop to 0.5% until conditions stabilize. This defensive adjustment allows you to stay in the game during turbulent times without being forced to the sidelines entirely. Remember that professional momentum traders don't try to avoid losses completely. They expect some positions will lose money. The difference is they ensure those losses are small and manageable while giving their winners room to deliver outsized returns. A successful momentum portfolio might have 40% losing trades, but still deliver excellent overall returns because the winners are significantly larger than the losers. Think of proper position sizing and risk management as your portfolio's insurance policy. You hope you never need it, but you'd never drive without car insurance, right? Similarly, you should never enter a momentum trade without clear position sizing and exit parameters. The art of selling: when and how to exit momentum positions. Those exit parameters we just discussed? They're only half the battle when it comes to protecting your momentum profits. While almost every investor obsesses over which stocks to buy, the difference between success and failure often comes down to knowing exactly when to sell. The truth is, your exit strategy is arguably more critical than your entry strategy when it comes to momentum investing. Let me paint a familiar picture. You've done your research, identified a stock with strong momentum, and watched with excitement as it climbs 20, 30, even 40%. But then, seemingly without warning, the stock reverses course and your gains vanish faster than free food at an office party. Sound familiar? This happens because most investors simply don't have a disciplined exit strategy. The problem is that selling decisions are far more psychologically challenging than buying decisions. When a stock is rising, your brain is flooded with dopamine. You feel smart, successful, and you start dreaming about how much higher it might go. This is exactly where the disposition effect kicks in. That powerful psychological bias that makes us hold on to winning positions too long because we're afraid of missing additional gains. Before you know it, your 40% winner has turned into a 10% loser. This is why we need to focus on the 3 primary sell signals that can save your momentum portfolio from disaster. The first is trend reversal. when the underlying uptrend that carried your stock higher begins to falter. This isn't just about a bad day or two. It's about recognizing when the overall trajectory has fundamentally changed. One of the most reliable ways to spot a trend reversal early is through technical indicators like the Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD. When a stock's RSI begins to decline, particularly after reaching overbought territory, it's often an early warning sign that momentum is weakening. Similarly, when the MACD lines cross in a bearish pattern, it frequently signals that the upward momentum is losing steam. The second major sell signal is relative strength breakdown. Remember that true momentum isn't just about a stock going up. It's about a stock outperforming both its sector and the broader market. When this relative outperformance begins to fade, it's often one of the earliest warning signs of trouble ahead. Let me show you how this works in practice. Imagine you own a technology stock that's been a star performer for months. It's still rising, but you notice that other technology stocks are now rising faster. This subtle shift in relative performance is often your first clue that institutional investors are rotating their capital elsewhere, and that your stock might soon follow with a more significant decline. The third key sell signal is time-based exits. Some momentum trends simply run their course naturally. Research shows that momentum effects typically persist for 3 to 12 months before beginning to fade. If you've been in a position for a significant period and the rate of ascent is slowing, it might be time to consider taking profits regardless of other indicators. Now, implementing these sell signals doesn't mean you have to exit positions completely all at once. This is where partial profit-taking strategies come into play. One effective approach is to sell a portion of your winning position when it reaches predetermined profit targets. For example, you might sell 25% of your position after a 20% gain, another 25% after a 35% gain, and so on. This strategy accomplishes two important goals. It locks in profits that can't be taken away from you while still keeping you in the position if the uptrend continues. It's essentially having your cake and eating it too. You bank some gains while still participating in any further upside. The psychological challenges of selling winners run deep. Even professional investors struggle with the fear of missing out on additional gains. The key is to reframe how you think about selling. Instead of seeing it as missing out on potential future gains, view it as protecting the very real gains you've already earned. One technique that helps overcome this psychological barrier is to ask yourself, if I didn't already own this stock, would I buy it today at this price? If the answer is no, that's a strong indication that it's time to sell, at least partially. Another approach is to document your selling rules before you even enter a position. Write down exactly what conditions would trigger a sell decision, whether it's a specific technical indicator, a relative strength breakdown, or a time-based exit. Then commit to following these rules regardless of how you feel emotionally when the time comes. Professional momentum investors understand that selling isn't about perfectly timing the top. It's about systematically capturing the majority of a trend while avoiding the typical fate of watching substantial gains evaporate. They know that early exits from momentum positions generally lead to better overall returns compared to late exits. In fact, portfolios that sold stocks at the first sign of weakness have historically outperformed those that held onto positions until significant declines occurred. This is because momentum reversals tend to be swift and severe, leaving little time to react once they're fully underway. Portfolio rebalancing. Optimizing your momentum strategy. Managing your momentum portfolio isn't just about picking the right stocks. It's also about knowing when to refresh your entire strategy. While we've covered the importance of exiting individual positions, there's another critical timing decision that could make or break your returns: portfolio rebalancing frequency. You might think that constantly updating your momentum portfolio would yield better results. After all, staying on top of the latest market trends seems logical, right? But here's the counterintuitive truth. Rebalancing too frequently can actually drain your returns faster than leaving your positions alone. When you rebalance your momentum portfolio, you're essentially doing a complete checkup, evaluating which positions still meet your momentum criteria, which ones need to be sold, and which new opportunities deserve a spot in your portfolio. But each of these transactions comes with costs that can eat into your profits. Let's talk about what the research actually shows. A fascinating 2019 Vanguard study examined portfolios with a 60-40 mix of stocks and bonds that were rebalanced at different intervals: monthly, quarterly, annually, and never. Surprisingly, they found little difference in performance across these time frames. But this was for traditional portfolios. Momentum strategies tell a different story. For momentum portfolios specifically, the optimal rebalancing frequency isn't one size fits all. It varies dramatically based on your portfolio size. If you're working with a smaller portfolio of around $5,000, research indicates that rebalancing bi-yearly to quarterly can maximize your returns. But if you're managing a larger portfolio, say $1 million, monthly rebalancing often proves more beneficial. Why this difference? Transaction costs hit smaller portfolios harder. When you're working with $5,000, every $7 commission or small bid-ask spread represents a much larger percentage of your total assets compared to someone trading with $1 million. These seemingly minor costs compound over time and can significantly erode your returns if you're trading too frequently. But there's another factor at play. Trading frequency can decrease portfolio volatility at a faster rate than it decreases performance. This creates an interesting dynamic where the sweet spot for momentum strategies ranges from bi-yearly to monthly, depending on how much money you're working with. Let me share a brilliant approach that professional momentum investors use: the overlapping portfolio strategy. Instead of rebalancing your entire portfolio at once, you might divide it into 3 equal parts. Then, you rebalance just 1/3 of your holdings each month, creating a rolling 3-month cycle for your complete portfolio. This approach offers the best of both worlds. You're regularly refreshing your positions to stay current with market trends, but you're not incurring the massive transaction costs of rebalancing everything at once. Plus, you're reducing the volatility that can come with all-or-nothing portfolio turnover. When conducting your rebalancing, an effective portfolio review process is critical. Start by evaluating each position against your momentum criteria. Has its score dropped below your threshold? Has its relative strength versus the market weakened? Is volume declining while price continues to rise? These are all warning signs that might trigger a sell decision. Next, look at your sector allocations. Markets are constantly rotating leadership, with different sectors taking the lead at different points in the economic cycle. During your rebalancing, you might notice that technology stocks are losing momentum while energy stocks are gaining strength. This would signal that it's time to shift some of your allocation from tech to energy to stay aligned with current market trends. For a sophisticated approach to rebalancing, consider implementing a 2-pronged strategy. First, use calendar rebalancing, adjusting holdings at predetermined intervals like monthly or quarterly. Second, incorporate percentage of portfolio rebalancing, which focuses on maintaining target weights for each asset class or sector. If your technology allocation has grown from 20% to 30% of your portfolio due to strong performance, you might trim it back to your target weight and reallocate those funds to underrepresented sectors. Remember that the goal isn't just to stay current. It's to optimize returns while minimizing costs. For most retail investors with moderately sized portfolios, $50,000 to $250,000, quarterly rebalancing hits the sweet spot. It allows you to stay reasonably current with market trends while keeping transaction costs under control. Here's a practical tip. Schedule your quarterly rebalancing sessions on your calendar a year in advance. Treat them like important business meetings that can't be missed. During volatile market periods, you might consider more frequent reviews, but stick to your predetermined rebalancing schedule for actual trades unless your momentum indicators are flashing urgent warning signals. Another advantage of quarterly rebalancing is that it helps you avoid the emotional pitfalls of more frequent trading. When you're constantly watching your positions, it's easy to overreact to short-term fluctuations that might just be normal market noise. The quarterly approach gives you enough distance to see the forest for the trees. The data is clear. While higher trading frequencies can potentially lead to better gross performance, they also incur higher transaction costs that can offset or even eliminate those benefits. Finding your personal optimal frequency means balancing these competing factors based on your specific situation. Avoiding the momentum traps. Why most fail and how you can succeed. Even with the perfect rebalancing schedule, most momentum investors fall into invisible traps that demolish their returns. Think you're immune to these mistakes? The research shows that the difference between momentum winners and losers isn't their strategy. It's whether they can avoid these 4 deadly pitfalls that claim most investors' profits. Here's a shocking truth. Even investors who understand momentum principles inside and out still underperform the market. The problem rarely lies in the strategy itself. Momentum has proven its effectiveness across centuries of market data. Instead, it's the gap between knowing what to do and consistently executing that plan when real money and emotions are involved. Let's tackle the first major pitfall: performance chasing. This is where most momentum investors get it completely wrong. When you see a stock skyrocketing on CNBC or dominating your social media feed, your natural instinct is to jump in. But by then, it's often too late in the price cycle. This behavior is primarily driven by emotional biases like FOMO, fear of missing out, and recency bias, where our brains give disproportionate weight to recent price movements rather than long-term trends. The true momentum investor identifies trends early through systematic screening, not by chasing stocks already making headlines. The second deadly trap is inconsistent application of your momentum rules. Picture this. You've built a solid momentum system with clear buy and sell criteria. Everything works beautifully until the market gets volatile. Suddenly, those rules feel too rigid or too aggressive, so you start making exceptions. This stock is different, you tell yourself. I'll hold on to it a bit longer despite the sell signal. This inconsistency is particularly devastating during market turbulence, precisely when a disciplined approach would protect you most. Emotional decision-making leads to missed opportunities and staying in deteriorating positions far too long. The third pitfall might actually be the most dangerous because it's so deceptive: overconfidence after early wins. When your first few momentum trades deliver impressive gains, something shifts in your psychology. You begin attributing these successes to your superior skill rather than the strategy itself or even market conditions. This overconfidence leads to excessive risk-taking, perhaps doubling position sizes or ignoring stop losses because you're on a roll. The result: holding losing positions far longer than your system dictates, hoping for that turnaround that never materializes. Those early profits vanish faster than they appeared. The fourth major trap that claims momentum investors is failure to adapt to changing market conditions. Markets shift between trending and range-bound environments, between low and high volatility regimes. A momentum approach that works brilliantly in strong bull markets might bleed money in choppy, sideways conditions. Investors who stubbornly stick to the exact same parameters, regardless of market environment, often find themselves continuing to invest in underperforming assets, leading to substantial losses when the market climate has fundamentally changed. So how do we avoid these traps? Let's build a practical defense for each one. To combat performance chasing, implement strict volume analysis alongside your momentum metrics. Low trading volume may indicate a lack of real conviction in a price move, while high volume confirms a genuine trend. Only consider stocks where price increases are supported by strong volume. This single filter will save you from countless fake breakouts. For inconsistent application, create a written trading plan with specific entry and exit criteria before you place a single trade. When emotions run high, you won't have to think, just follow your pre-established rules. Some investors even use a simple checklist that must be completed before any buy or sell decision. This creates a cooling-off period where you're forced to rationally evaluate whether you're following your system or making an emotional exception. To prevent overconfidence, implement a risk management framework that automatically adjusts your position sizing based on recent performance. If you've had several winning trades in a row, your system should actually reduce position sizes, not increase them. This counterintuitive approach protects you from the natural tendency to take excessive risks after a winning streak. For adapting to changing markets, maintain a market environment indicator alongside your stock-specific momentum metrics. This might track volatility levels, breadth, how many stocks are participating in trends, or correlation between sectors. When your indicator shows a major shift in market structure, adjust your momentum parameters accordingly, perhaps tightening stop losses or reducing position sizes during high volatility. Consider creating an implementation checklist that includes defining clear entry and exit criteria, scheduling regular portfolio reviews, and establishing a process for identifying when your emotional biases might be interfering with proper decision-making. This checklist serves as a reality check against behavioral challenges like myopia, focusing too much on short-term performance, and regret aversion, holding losing positions to avoid realizing losses. Remember that successful momentum investing demands continuous monitoring of broader market conditions, including macroeconomic indicators and sector performance trends. This vigilance allows you to pivot your strategy. That vigilance becomes second nature once you've established your momentum system. But how do you actually get started? Most investors fail at momentum strategies not because the concept is difficult, but because they never implement a systematic approach. Let's fix that with a 7-day action plan that turns theory into actual profits in your portfolio. Day 1 is all about creating your momentum screening criteria and building your initial watch list. Start by focusing on stocks that have shown strong performance over the last 3 to 12 months. Look specifically for stocks trading above their moving averages. This is a key signal that upward momentum might continue. Using any basic stock screener, even free ones work great. Filter for these outperforming stocks and compile a list of 30 to 50 candidates. Remember, you're not buying anything yet, just creating your foundation. On day 2, it's time to build your momentum scoring spreadsheet. Don't worry, this doesn't need to be complicated. Create a simple Excel or Google Sheets document with columns for stock names, recent performance metrics, and momentum indicators. Include spaces to track price changes over different time periods, and add columns for technical indicators like RSI and MACD. This spreadsheet becomes your command center, the place where gut feelings get replaced with data-driven decisions. Day 3 focuses on analyzing current sector strength. This is where so many investors miss huge opportunities. Pull up ratio charts comparing different sectors against the S&P 500. Which sectors are outperforming the market right now? Which ones are gaining momentum? This analysis helps you focus your attention where the money is flowing. Remember that sector trends often precede individual stock movements, so identifying the strongest sectors puts you ahead of the crowd. For day 4, develop your position sizing rules and risk parameters. This is absolutely critical. Without proper position sizing, even the best momentum strategy can blow up. Determine exactly how much capital you'll allocate to each position based on its momentum strength and volatility. A good starting point is risking no more than 1 to 2% of your total portfolio on any single position. If you're starting with $5,000, that means no more than $50 to $100 of risk per position. Write these rules down. They'll save you from disaster later. On day 5, create your buy and sell rules document. This is your investing constitution, the rules you'll follow regardless of how you feel about a stock. Outline specific criteria for entering positions, momentum score thresholds, volume requirements, etc., and exiting positions, stop-loss levels, technical breakdown signals, etc. Having these rules documented removes emotion from your decisions and prevents you from moving the goalposts when a trade isn't working out. Day 6 is about setting up your portfolio tracking and review schedule. Decide exactly when you'll review your momentum stocks, ideally quarterly for most investors. Create calendar reminders for these reviews and stick to them religiously. During these sessions, you'll assess each position, recalculate momentum scores, and make necessary adjustments. This systematic approach keeps you disciplined and prevents the portfolio drift that kills returns. Finally, on day 7, it's time to make your first momentum-based investments. Start small. Pick 2 to 3 of your highest conviction stocks that meet all your criteria. Don't feel pressured to deploy all your capital at once. By starting with a few positions, you can test your system while limiting your risk. As you gain confidence and experience, you can gradually increase your exposure. What can you realistically accomplish in 1 week? You'll create a watch list of potential momentum stocks, build a scoring system, and make your initial trades. This gives you a solid foundation to build upon. If you're just getting started, consider beginning with around $5,000 focused on a limited number of stocks. This approach minimizes risk and transaction costs while allowing you to learn and adjust your strategy. The beauty of this 7-day plan is that it transforms abstract concepts into concrete actions. You're not just learning about momentum investing, you're implementing it step by step. Each day builds on the previous one, creating a complete system that can be maintained with just a few hours each month. What makes this approach different from random stock picking? Instead of chasing hot tips or panic selling during corrections, You'll have a quantifiable system that tells you exactly what to buy, when to buy it, and when to sell. Your decisions become data-driven rather than emotional, dramatically improving your odds of success. Remember that this 7-day plan isn't just about making a few trades. It's about establishing a sustainable investment process. The real power comes from consistently applying these principles over time, allowing compounding to work its magic. Many investors who follow this approach find they spend less time worrying about their investments while achieving better results. As we wrap up, I want to share something powerful Tony Robbins points out about momentum. People who succeed have momentum. The more they succeed, the more they want to succeed, and the more they find a way to succeed. That's not just motivational talk, it's backed by hard data. Top quartile momentum stocks have delivered 10% annual returns over a 13-year period, while bottom quartile stocks lost 2% annually. The beauty of momentum investing isn't that it requires genius-level intelligence or insider information. It's simply about following a system that works with market psychology instead of fighting against it. Your edge comes from consistency and discipline. Start small tomorrow. Create that screening criteria, build your tracking spreadsheet, and make your first momentum-based investment. Remember, you're not trying to predict market tops or bottoms. You're identifying what's working right now and staying with it.